For people who are still not quite aware of what your central contribution, I think, to the whole financial literature is, maybe you can reiterate for us briefly. Could you describe what a random walk is, and where did the phrase random walk come from? Is that a mathematical phrase, or does it describe something in particular? Just give us 30 seconds on that. For
random walk is a mathematical term. And what random walk really means is the market cannot be predicted in advance. I don't know what's going to happen. Is the market going to continue to go down tomorrow? Is it going to bounce back? I don't know, and nobody else knows. So the best thing to do is stay the course. And the best thing to do, since we don't know whether growth is going to be better than value or small is going to be better than large, is to simply buy a broad-based, low-cost index fund, and ETFs are now available at essentially a zero cost, and stay the course. And that's going to be the way to have the best long-term portfolio. And let me just say that Standard & Poor's, which is basically the company that measures how well index funds have done, they published something called a SPIVA report. That is how the S&P indices compare with active managers. And what happens is, year after year, 2/3 of active managers are outperformed by an index. The ones that outperform one year aren't the same as the ones that outperform the next year. So that when you compound this over 15 years, what the SPIVA reports show is that 90% of active managers underperform. I'm not saying that nobody can outperform. Certainly there are people who do outperform, but it's a tiny, tiny fraction. And if you try to go active, you're much more likely to be under the curve than over the curve. And I believe even more strongly than I did 30, 40 years ago that index investing ought to be the core of every single portfolio. And ETFs are a beautiful way to do it.
You know, Dave, you and I know this. Of course, we talk about it all the time. But there is something when I bring this up that people, it gets under their skin. People don't like the idea that everything is just random. It just bothers them. The human brain seems to want to look for patterns because that helps us order the world and make sense of the world, not that the world is a coin toss. Have you found a way to break through that sort of mental block that people have to describe what Professor Malkiel is talking about, this randomness?
Yeah, I mean, fundamentally, this is the Lake Wobegon problem. Nobody wants to admit that they're going to be average, and Professor Malkiel is, of course, absolutely right. If you want to have the highest opportunity for the maximum performance, the thing to do is buy a big, broad index fund and forget about it for as long as possible. You know, a recent study at Fidelity showed that the highest performing accounts they had were those that had either been abandoned or where the owner of it was dead. And I think that speaks volumes. That being said, I do think the active funds we're seeing, certainly in the headlines today, are a little bit different than those average active funds in that the ones that are being successful are extraordinarily high conviction, meaning they're only holding 30, 40 stocks. They're holding fairly large positions. Again, you would expect mathematically, if you put all of those high conviction active managers together, they're going to underperform the market by roughly their fees and trading costs. But I don't think that's ever going to stop people from trying to, as you put it, find those patterns and exploit them.
Yeah. Professor, this random walk idea actually applies to other fields besides the stock market. For example, I've heard you talk about basketball players before. I know you're a sports enthusiast, that even in basketball, it's essentially a random walk. Can you describe that? And do basketball players believe it when you tell them, I'm sorry, but it's really just, 50-50 whether you'll make that basket the next time or not?
No, as Dave says, it's very, very hard to believe. And the players themselves absolutely believe that there are patterns, that there's a hot hand. If you're a 50% free throw shooter and you've made 3 or 4 of your last free throws, basketball players will tell you it's much more likely than 50-50 that you're going to make the next one. And when you look at this mathematically, it just isn't true. It doesn't matter. It's like flipping a coin. If you flipped 3 heads in a row, that doesn't mean that you're going to get a head the next time. It's very hard for people to believe. The basketball players themselves don't believe it, but it's unfortunately true, and you ought to act as if it is random and it is unpredictable. It's not that one free throw shooter who's a 70% shooter isn't going to be better than a 20% shooter, but from one shot to the next, the fact that you've been good the last 3 or 4 shots doesn't mean a thing.
Right. But you just made a key point. You're not saying that talent doesn't matter. If a 70% free throw shooter is better than a 50% free throw shooter, but they fool themselves into thinking that there are patterns there that aren't, right? It's not that talent doesn't matter. Okay.
Talent
let me just move
matters.
on.
Yeah, go ahead.
Go ahead. So if the stock market is a random walk, is it a perfect random walk? I don't want to get too deep into efficient market hypothesis, but can you briefly describe that to us and why that's very important to your basic idea here? It seems to me people don't understand it properly. So generally, efficient market hypothesis says that asset prices reflect all available information. Some people seem to think that that means that it actually says that the prices are accurate. But as you pointed out, that's not exactly what it says. Could you tell us very quickly what efficient market hypothesis is and what it is not at the same time?
Sure. What it is that news gets reflected very quickly and that prices move relatively randomly. What it's not, absolutely not, is to say that it means that market prices are always right. In fact, I like to say they're always wrong. The problem is we don't know for sure whether they're too high or too low. Now, with respect to patterns, let me admit that there are some patterns. The market, if you had a mathematician on the program, the mathematician would tell you, yes, I've looked at the pattern of stock prices, and it's not a perfect random walk. It's close, but not a perfect one. Why is it not a perfect one? It's not a perfect one because there is some momentum. And there's no question about it. It's one of the reasons why factor investors actually look for momentum patterns. But there are also momentum crashes. And the problem is momentum works sometimes, but sometimes it fails terribly. And you can't simply be a momentum investor through time and know that you're going to outperform, because you won't over time, even if you will during some periods.
Right. Well, let me just follow up with that. And Dave, I want you to jump in after this, but I want to just follow up with that question. So if the market's not a perfect random walk, what patterns are there? I guess we're trying to figure out what advice can we give the average investor here. So there's been some academic evidence, I know, that some factors, value, for example, small caps, momentum you mentioned, or quality generically seems to work for short periods. Is there evidence that this kind of factor-based investing really works over long periods of time? Because the ETF community has certainly embraced those factor-based concepts, which I know are based on some, earlier academic research done by Fama and yourself and others that are out there. But what can we do with this information? Does factoring work?
So I'll jump in there first.
Yeah, I
think factors.
Go ahead.
Factors absolutely can work. I think what people get into trouble is they think that there's some sort of magic bullet, and that if I only get the timing right from going into low vol into momentum, I'm going to generate many percent alpha. That's not really what a multi-factor portfolio does. A really modern, well-constructed multi-factor portfolio really just sort of changes your risk-reward paradigm fairly slightly. It gives you a little bit of extra or a little bit of risk reduction, and increasingly the evidence suggests what it's really doing is helping you reduce risk more than anything else. And I think it gets to the previous point. It's not that, that all information is in every stock price and therefore stocks are perfectly priced. We have constant new sources of information, a lot of work being done recently, for instance, on the importance of liquidity and how that can impact stock prices in unpredictable ways. So I think there's always new information being absorbed, and the folks that are there absorbing it and processing it with a level head have an opportunity to generally reduce their risk a little bit.
Yeah. Professor, why don't you follow up and sort of answer that question, too? I think Dave did a good job on it. But is there any evidence that factoring work or factors work? The ETF community has certainly embraced it. And perhaps about the multi-factor approach. Dave mentioned that.
Sure. If you're going to be a factor investor, I believe in a multi-factor approach. And the reason is that the factors tend to be negatively correlated. That is to say, when value fails, momentum tends to do well. And so I agree entirely with Dave that this is possible to have a multi-factor portfolio that tends to reduce risk and gives you a little higher Sharpe ratio. The Sharpe ratio is return relative to the risk you are taking. So I agree with Dave that that is possible. Now, you want to do this, however, at low expense. If you've got a multi-factor portfolio and you're charging 100 basis points, I say avoid that like the plague. But if you can get an ETF that's 10 basis points or less that does this, it's a reasonable way to invest. And there is some evidence that firms like Dimensional Fund Advisors, who have used a multi-factor approach for quite some time, have in fact been able to get a little better risk-return trade-off.
So I'm not to be too plain-spoken, but what's the poor slob who's trying to figure out what to do take away from this? Should I be going out and buying a low volatility ETF with a momentum ETF, with a value ETF and a small cap ETF? I mean, it's a little confusing to give people actual advice. I know you're not a financial advisor, you're a professor, but that seems to be the implication of what you're saying. That's a multi-factor approach. Buy all of that stuff.
Well, I think it's much better to buy a multi-factor ETF rather than have to buy the individual ones. A low-cost multi-factor ETF is a much better way to do it. And do I think it's reasonable for someone to do that? I think that's absolutely right. I would, if I did anything beside a broad-based ETF that's indexed, I might do a multi-factor one. But again, I would not expect some greater performance. You might get a little better risk reduction, but still, I think the safest thing to do would be buy a broad-based index fund. If you're interested in the factor approach, buy one multi-factor ETF with as low an expense ratio as possible. And by that, I mean something that's around 10 basis points or less. Because let me tell you, Bob, the one thing, I think we all need to be very modest about what we know and don't know about the stock market. But the only thing that I am absolutely sure about is the lower the fee I pay to the purveyor of the investment product, the more there is going to be for me. That I'm absolutely sure about. I love to quote my late friend, Jack Bogle, who had this wonderful line that in investing, you get what you don't pay for.
That's a great line. One of many Jack Bogle lines that I've used down throughout the years. The other one, my other favorite, is the line, don't just do something, stand there, meaning use your brain in a crazy situation and make a poor investment or change where you're doing. Let me just ask you something about behavioral economics. I had to throw in one of these questions. So people thinking that the market is efficient means that the market is rational, but I think you've cleared that up. It doesn't really do that or say that. But one of the central findings of behavioral economics is that the irrational behavior is a big driver of markets. I've talked with Professor Schiller for many times about this. People don't buy low and sell high. They do the opposite, actually. So can poorly informed investors actually lead the market astray and make it less efficient, or is there some important philosophical or financial insight we can get from the lessons of behavioral economics?
No, as I said, I think efficient market theory does not say the market's always right, it's always wrong. But what we do know is that people, when they try to time the market, invariably they sell at the wrong time and they buy at the wrong time. They buy when everybody's optimistic, they sell when everybody is pessimistic, and that's just the opposite of what they should do. Don't try to do it. It's far better to simply buy and hold. And to the extent that you do any buying and selling, what I do recommend is rebalancing. That is to say, if you're in a situation where the market's gone crazy on the upside and your equity proportion is higher than you're comfortable with, then take a little money off the table and put it in safer assets. And when the market has, in fact, dropped precipitously and everybody is terrified about what will happen in the future, and your equity proportion has gone down to lower than the proportion with which you should be and you're comfortable with for the long run, then go and sell some of the safer assets and buy the market. So I do agree with rebalancing, but I do not think that you should actively try to time the market.
You know, Dave, you wrote a great story a number of years ago, which I still quote and go to, called The Folly of Market Timing, where you look at the simple observation that if you're not in the market for like the 10 most important days of the year, you're basically lost. If you are in the market at the worst days of the year, you still lose. But your point of your story was nobody knows. There are 10 days that are really important and nobody knows what the days are.
Yeah, and I feel like that's true not just in investing. I think it's true in life, right? And, you know, I think most of us get paid for 10 days at work a year, and we just don't know which 10 days those are going to be. So we have to get ready for the rest of them. You know, but I think the point here is well taken. You know, your question, Bob, you know, what's an ETF investor to do? Well, I mean, it's in the name of your show, ETF Edge. If you don't know what the edge is, then you don't have one, and therefore you should just be in low-cost indexes. It's not that there isn't information out there available that people can get an edge with. It's just infinitesimally small and very difficult to get.